Hello, Tuesday, me again. Let's have a look at the national debt since 1700 for the UK as an exhibition of what you can do when you've got an empire. Percentage of debt to GDP, basically, and no debt in 1700 because the government was only little. But then it got more and more as they fought wars and wars, but they won the wars and got an empire. War of the Spanish Succession, the Austrian Succession, 7 Years' War, American War of Independence. That wasn't so much a win as just a cost of money. And in the end they're the Revolutionary and Napoleonic Wars, which is really a defensive war, as in, although Waterloo was won by the Redcoats, it didn't mean that they could go to France and steal all the stuff from the chateaus, because the peasants of France had already done that anyway. And after that, Victoria's reign, 1820 to just after 1900, 1901 I think it was, the debt came down and down as the empire was out there and owned, and it was being sucked dry. And that money that was being sucked into the UK went to pay off the debts. And then it went all a bit rotten with the Boer War down in South Africa, World War I and World War II, which nothing was to be gained from, really. And it was just amounts of outgoings. And then financial repression from the end of the Second World War to the great boom of the Thatcher era. Got the debt all the way down. It cost the people. It wasn't a particularly happy time. And this little false boom that's going on at the moment, and you can see where it is, and just a bit of a forecast down there. But compared to the old empire days, it is a mere nothing. But of course, the empire is no more, so it doesn't count anymore. It doesn't mean they can go back up to those orange heights. Housing bubbles. This is from Rebecca Wilder in Neural Rubini's site. Housing bubbles. And this is as a ratio to rents. And somehow she's pulled it all together at the start of the chart in 1997, where they were all the same, and shows the heights, the respective heights of the housing booms, with the United States being the lowest one in blue, and it's come down furthest, and it's down to 1-to-1 rents. The two in the middle are the the red one is Spain, that's Eurozone, and then, purple is Ireland, is down to 1.4 to rent now, with the UK at the top at 1.6 rents. The most expensive, but the UK is meant to be different because it's so small and there are so many people and they all want houses. And quite frankly, we met Richard and Chrissy yesterday, and if they can rent their house off the bank for £400 and something a month, that's quite fine. It's fine with the bank and it's fine with the government. The government, if they couldn't rent it off the bank, they'd have to rent it off somebody else and probably get the government to pay for it. So the government is happy for them to rent it off the banks. How old were they? About 25. They'll be paying that rent to the banks. It's probably a 20-year mortgage, but it's one of these interest-only mortgages, and they'll just be paying it off for the rest of their life. They'll come to 20 years and realise that they haven't paid the principal off, and then they'll start thinking they're paying the principal off, but they will have put more interest on it. 40 years later, they'll find themselves in the same situation, and quite frankly, when they're 85, in 60 years' time, they'll still be renting that house off the bank. Obviously, some things will happen in between, but the general thing will be that the bank owns the house, and that just the Richard and Chrissy or their children will just rent it off the bank for the rest of their lives. Anyway, you can see that the US housing market has come down the lowest, but they need the Richard and Chrissys of the United States to be working on constructing new houses. Well, Chrissy doesn't have to work building new houses, but their Richards will, to get enough money in to be able to buy the newly constructed house or bid up the price of existing stock, which is large in the United States. In other words, they really need a construction boom or a manufacturing boom for the non-brilliant individuals to get some money in so they can afford to either rent off somebody they can rent off or rent it off a bank, because they'll do the similar thing in the United States, I would think. Right, let's move on to California and tax revenue 2012 and 2011 comparison, and Mish has pointed this out, that it's a huge drop in California's taxing. They were really getting on top of getting the taxes in. They had a really bad time in 2009, but 2010 and 11, it's John Chang, isn't it, in charge there. It got on top of it and they were getting lots of taxes in, but this is a big drop. You can see at the top there in personal income tax was, now they use thousands, don't they? So this is 1 million thousand, so that's a billion, so that's 2 billion they were getting in taxes in 2012 for personal income, and it's gone down to 1.6. And for retail sales it was 3.2 billion and it's down to 2.4, a really big drop. And Johnny will be tearing his hair out, because the bottom line is 5.6 billion in 2011 is down to 4.3. So they'll have to put taxes up, won't they, in California? Because why? Because that's what they do. Yeah, that'll work long term. Right, let's go to Martin Feldstein in the Financial Times and a grotty little article. Obama tax rises threaten the US recovery. Now this is, I'll read it and come back to my theory, and it's my theory and nobody else's theory. The recent payroll gains and the declining unemployment rate in the United States have raised hopes that the economy will now start growing faster than the tepid, 1.7% rate of last year. Optimists are expecting growth rates as high as 3% for this year and next. That's almost a bit more than blah plus. I hope they are correct. The recession that began in 2007 was deep and painful. The recovery that began in June 2009 has been slow and grinding, and in spite of unprecedented fiscal outlays and even larger monetary stimulus. Well, that's just saying they've done all these things and it's still only blah to blah plus. House prices have continued to fall and housing construction remains dormant. That's Richards aren't being employed there. Because this is the bit I'll come back and read again, so you're going to listen to this twice. Because of Barack Obama's government's failure to reduce the large number of homeowners whose mortgage debt exceeds the value of their homes. I'll come and read it again. And, of course, business investment has been depressed by anti-business rhetoric and policies of Mr. Obama's administration. I don't really go for that last line at all. Barack Obama's not my favourite, but he hasn't been particularly against business, I don't think. And the headline there is Obama tax rises threaten US recovery. I don't think there will be tax rises. That's my theory. And I don't think there will be interest rate rises. And that's my theory. But look at this line. What was... And this... Feldstein, he's a bit of a right-winger, isn't he? I think. But... what? Because of Barack Obama's government's... His government's failure to reduce the large number of homeowners whose mortgage debt exceeds the value of their homes. So the government could only do two things. They could raise the value of the homes or drop the debt that the people owe. And I wouldn't have thought that dropping the debt that people owe would be a right-wing thing to do. So Feldstein obviously thinks that Obama should have done more to raise house prices, or his government. Interfering in the markets, not free markets. What's going on? In the Wall Street Journal, they have a regular thing where they do a poll of all their people and ask them all sorts of questions. And it's quite interesting if you follow the link to get their opinions on all sorts. But I got this one as the interesting thing. 2013, will taxes rise? And this kind of shows the confusion that is out there. Because 47% no and 53% yes. And it's an interesting thing that these experts are split almost up the middle of taxes will rise or taxes won't rise. Should we go on? I mean, we've got the Bush tax cuts, which are now permanent, but they still talk of letting them go and bringing them, taking them off, putting the taxes up, and other taxes are due to go up. There are lots of taxes due to go up, but I don't see how they can ever again. Cullen Roche, Prague Cap, was having a bit of a question and answer session because he had a very good comment post thing going, and several readers came in with a question something along the lines of, if Mr. Bernanke and the Fed are wrong and we have a sudden surge of inflation, what can they do to stop it in its tracks, or maybe back it off to reverse the damage, or would they just say, oops? And Cullen says, as I've been saying for several years now, a sudden surge in inflation will likely come from one of two places. Now, I've marked them in yellow because I think there are three places that he's got here. An oil price shock. Now, we can all agree that there could well be an oil price shock. Let's just say Iran, if nothing else, just to give us a shorthand reason why there might be an oil price shock, which will likely drive us into recession and cause a bust with an ensuing price decline. In other words, the bust causes the price of oil to go down like it did last time. Last time it went down to nearly 30, but I think that's very unlikely that it'll go down anywhere near there. Let's say the next recession it goes down to somewhere near 60, and then they get going again, and then the next recession it comes down to nearly 90, something like that. But the idea is that the recession causes the price of oil to go down, and then the whole economy can get traction again and get moving again on the slightly cheaper oil stroke gas. But that is a very American-centric idea. We have got a world economy now, and just because America goes into recession doesn't mean that little Chinese people won't want to be driving their cars around. Okay. Or, this is number two, we'll get an economic boom. This whole thing's quite unlikely, but it's got to be taken into consideration. Or we'll get an economic boom and prices will rise because employment is surging. Employment is surging. Doesn't sound right, that, does it? Output is booming and the economy is generally well out of the doldrums. I don't think the Fed would say, oops, in this situation. I think they'd say, see? We were in. See, we told you we had this under control. And then everyone will start calling the Bernanke the new maestro, even though it was the fiscal stimulus that saved our skin in the balance sheet recession. And if that really does happen, they'll go through the standard motions of raising rates, etc., and probably unwinding their portfolio at the Fed. All of that highly unlikely, isn't it? And they'll maintain the belief that QE was the thing that caused inflation when it wasn't. I've marked another yellow because I think this is the third option. I see the likelihood of a 70s stagflation as very unlikely unless we get an oil price shock like the 70s, which can't be entirely discounted, especially given the situation in the Middle East. So we've got the oil price shock this time, but it's like the 70s, and it sticks, and wages have to go up to compensate for the rise in energy prices. But we're unlikely to get the rise in the wages cranking up inflation over and over again, because that's what you must do with inflation. One little spike up like we've had doesn't do it. It's got to be a shock every single year to stack on the last year. Another 9%, another 10%, all mounting up. But there's nothing against a very slow and gradual ramping up in the price of gas. But then you've just got to factor in, well, what is then going to happen to wages? Are they going to go up pro rata with the gas prices, or are they going to keep falling behind and the economy falling behind? Anyway, it's a good link with Cullen's answers to many interesting questions. Right, let's fly over to Europe and the Bundesbank. And the people that are following it, it's Target 2. And if you know what Target 2 is, you'll probably recognise this from the Bundesbank. And we've got 2011, 2012, a 12-month period. And the Target 2 balances have gone from €494 billion up to €528 billion. So it is cranking up on the Target 2 side. Whether you think that's important or not depends on what you've read. And this probably the easiest prognostication forecast that could have been made. Germany on a different track. While much of the Eurozone deals with busts, property prices are rising in Berlin, Munich and Hamburg. Frankfurt, Europe's low interest rates are fueling rising house prices in Germany, presenting the region's policymakers with fresh challenge in their fight to restore its economic health. Signs of a property price boom in parts of Germany are becoming a headache for the ECB, which has, for the past 2 years, struggled to fashion a single stance on interest rates and support for the banks that fits countries as disparate as depressed Greece and mighty Germany. Everyone's saying the way out of this is for an inflationary flare-up in Germany, which is highly likely. And we finish here to represent the they call it depressed Greece, but there is Portugal, Ireland, Italy and Spain, which is starting to get into the press a lot more. Spain and Brussels blog in the Financial Times, is the IMF already assuming a Greek failure? On Friday last week it was, and it's taken, I had a look at the report, but damn hard to get through. After much of Europe's shut down for the week, International Monetary Fund issued its 231-page report on Greece's new €174 bailout, which seems to struggle to keep an optimistic tone about Athens' ability to turn itself around over the course of the rescue plan. It's not in the slightest bit optimistic. Basically, it's saying, right now, we're telling you this second bailout is going to go wrong as well. They're getting that in literally a week and a half after the bailout went through, just so they can't say, oh, you got it wrong. They're not getting it wrong. They are definitely saying the second bailout isn't going to work, just like the first one didn't work, and nor will the third one. And what is the ECB to do? Can it raise rates for Germany and crush the South, or keep it low for the South and know that there will be a bit of an inflationary flare-up in the North? Very, very tricky. Bye.